Now we have the excitement of going into China. So let's just look at some of the data that has come out outside of the GDP piece, because we'll talk about it in a minute. But when you look at aggregate financing, came in slightly better than expected. M2 in line, down from the prior, which is, I think, the underlying, again, the tightness of it all. So new yuan loans, slightly better than expected, but money supply. So M1 and M2 shrunk. Excuse me. And that's going to be a big piece to watch going forward. So now when we look at exports, so exports were supposed to be at negative 7.1, came in at positive 14.8. Imports were expected to be at negative 6.4, came in at negative 1.4. So you still got a nice little export bump, but the imports are still showing you trouble. Because remember, imports are a direct correlation into where are exports going to be in the future. And as we've talked about with the PMI, on both the official and unofficial, or Caxton, if you will, you saw that new export orders are either kind of flat to slight contraction. So that kind of matches up with some of the problem, pressure points. Then you look at new home prices. Previous month were 0.3, came up 0.44. So again, that's a positive when you start looking at home prices. But based on how aggressive they came down, you're seeing, you essentially saw an elevator down, and now you're seeing a very slow grind up. Positive to go up, but again, not to the same degree. Now you look at lending facility rates, it's kept flat. And given where the GDP is, where some of this data is, there's no indication that you really have to see a decline in rates, or what the PBOC, or realistically stimulus. So now when you look at GDP, expectation was for 4%, came in at 4.5. Quarter over quarter was expected at 2, came in at 2.2%. So we're going to want to unpack that, because industrial production was expected at 3.5, came in at 3%. Industrial production year on year expected at 4.4, came in at 3.9. So again, you saw the industrial side shrink, which is consistent with what we were expecting in March, just given some of the problems that we've seen. And after you got that nice little catch up in January and February, now you're starting to see that contraction, which we saw with those leading indicators, as we talked about with the PMI numbers. Retail sales expected at 3.7, came in at 5.8. Retail sales year on year expected at 7.5, came in at 10.6. That's better. We want to talk about that more in a minute. And then fixed assets expected at 5.7, came in at 5.1. Property investment expected at negative 4.7, came in at negative 5.8. That's one that's going to unpack, because that's a big component of GDP going forward, which is why when you look at some of the numbers based on beating estimates by such a wide margin, it's like, well, but how, if industrial production was down, fixed assets were down, and residential property investment got crushed? So then you start looking at some of the key pieces, jobless rates, fairly in line, but we'll talk about that in a minute, because it's not equal across the board. But again, based on all of this, why would the PBOC adjust the prime rate loan? So again, that stayed flat. And then when you look at foreign direct investment year to date, the prior was 6.1%, and this one came in at 4.9%. So again, kind of a mixed bag, but mixed to the point where you're like, all right, well, how did you get this surprise growth? And those are some of the things that we're going to unpack. But first, everyone likes to talk about how the U.S. is evil and how, U.S. does terrible things and whatnot. But world powers are world powers, and they try to provide influence in different ways, sometimes for the better, sometimes from the worse. It's always going to be based on the lens. Some people always have a rosy lens. Some always have a negative lens. We like to think we have a fairly balanced view, and there's good and bad. But one that we know and love is Israel-Palestine. And as countries try to emerge on the world stage, they try to get involved. And China is no different. So why not? China has now thrown its hat in the ring to try to solve the Israeli-Palestine conflict. And they've said that China is concerned about the current tensions between Israel and Palestine. The President Xi has proposed a global security initiative, and China believes that is the key to resolving the Israeli-Palestine question, is upholding the vision of common security. Have you heard that before? China supports Palestine and Israel in resuming peace talks on the basis of the two-state solution and is ready to play a positive role in this regard. Cohen thanked China for its willingness to support the settlement of the Israeli-Palestine conflict, but it seems difficult to solve the problem anytime soon. Settling the Israeli-Palestine conflict under the framework of the Global Security Initiative would be the ultimate endorsement of Xi's vision of collective security. But as I'm just going to say, to save everyone time, it won't happen. But again, it's just everybody tries to, because China always says they don't want to get involved. But when you get to a certain level, you always think you can get involved. And again, that's going to be a key piece. But it's also going to be a way to increase influence outside of the country and try to show that they're still in play, even as things continue to be problematic at home. Now, China residential property sales. When you look at the cumulative side, the survey was for 4.7 and the actual is negative 5.8. So when you look at it, it is just negative going back to 2022. So when you look at that bounce, that's all it is a bounce. You're still negative. So when you looked at fixed investment, you're starting to see a little bit of that rollover in infrastructure, manufacturing balancing out, but real estate is just staying negative. And again, when you look at how important real estate is to the local GDP or local economy for China, it's going to be problematic to see how was that possible? How is that beat likely given the fact that things are still firmly negative? Now, you did get a bit of a bounce, but you're still negative with more pressure coming as infrastructure, as we've been talking about, starts to roll over. Now, this is from China Beige Book, which I think does a good job of kind of breaking things down. And this is, again, from the National Bureau of Statistics of China. So China industrial capacity utilization went down in the first quarter. So the industrial capacity utilization rate in China fell to 74.3% in the first quarter of 23 versus 75.8% in the same period a year earlier. This was the lowest level since the March quarter of 2020. So you had housing was negative, construction was negative, and now you had a decline in industrial capacity utilization. So China's industrial capacity utilization fell about 2%, but the manufacturing component of GDP grew 2.8% year on year, and construction grew 6.7%, even though real estate construction and construction in general went down. So it's like, what? So again, you kind of get an idea of where some of the disconnect is. And again, not to say that GDP was negative, but a beat? Oh, okay. All right. So China's Stats Bureau released this data. So now let's look at what Trivium has said. So the economy expanded at 4.5% year on year compared to 2.9% in Q4 of 22. So GDP in Q1 was up 2.1% on a seasonally adjusted basis versus the previous 3 months. But in fact, the GDP data and corresponding economic numbers leave us unsure about the whole host of things. So let's break it down again. If the economy is recovering, why is corporate spending growth still so weak? FAI increased 5.1% year on year in the first quarter of 2023, the same growth rate for 2022 as a whole. So again, where was the bump? At first glance, it seemed that the strong household spending explained the discrepancy. Retail sales rose 5.7% versus a 0.3% decline in 2022. Fair. But now other data suggests households are still under considerable financial pressure. Urban household income increased by only 2.7% in real terms versus 1.9% in 2022 and 5% year on year in 2019. So again, not a lot of benefit for the local consumer. The urban unemployment rate remains stubbornly high. We'll talk about that in a minute. And it was 5.3% in March. So there was also a disconnect between government stimulus and weak industrial production. Infrastructure investment continued to grow at a fairly decent clip, increasing 10.8% in Q1, 9.9% year on year. But the value-added industrial output growth was up only 3% year on year in Q1 versus 3.6% in 2022. So it's like, well, how could you have been that much better than Q1? let alone beat estimates of 4%. So the absence of an across-the-board recovery as China reopens raises the question about its sustainability. And this is not, again, the slam dunk, because this is indicating it was all local consumption, which is very possible from the end of lockdowns, but to the degree that they're saying is unlikely. And that's, again, the whole thing is we're not saying that this is enough to be negative. It's, they didn't slow down. This is not a negative number. It's just they're based on the data, especially because inflation actually went down. So if people were buying so aggressively to be the full driver of the beat, inflation would actually tick up. And again, not to say that it's going to go parabolic, but it shouldn't go down given that dynamic. But inflation actually went down in Q1, not up, which again kind of flies in the face of where we are. So real GDP growth by industry, when you look at the total, when you look at primary, secondary, and tertiary in terms of some of the different pieces, but the consumer, based on catering sales, retail sales, clearly strong. So again, how much of this is going to persist? And if the consumer does persist, well, how can the PBOC stimulate? And again, you're starting to see kind of how a stimulating economy, a stimulating or a friendly or dovish central bank is very unlikely. So now when we look at the China Sales Manager Index for manufacturing coming down, services is again kind of flatlining, but Xi continues to tighten his oversight of China's senior leaders. Now on Tuesday, the party released its third 5-year plan to beef up the party's rules and regulation system. And that's the biggest problem is even though we keep focusing on this, the Xi is honing in on control. And that's something that we have to look at, because if you're a foreign company, well, how is this control going to impact me and my activities in the country when I can go to Vietnam, India, other nations? And that's why we see more of this pressure of companies exiting, which is going to put more pressure, not less, on the economy. So to step up supervision of officials' social lives, the party center will explore measures to increase oversight of leading cadres' social networks. We suspect their family members' social interactions overseas will also come under greater scrutiny. Again, these are things that happen when an area is getting more, not less communist, which is going to put a pressure on, let's just say corporate mobility, economic growth. Xi's persistent campaign to root out corruption has won unpopular support. The increased scrutiny on officials' social lives will make them less willing to interact with foreigners. That will increase mistrust and misunderstanding between China and the rest of the world, which again is going to make it difficult to see them get some of those flows. Now, when you look at China's beige book, so capacity utilization mean data for the manufacturing sector shows a straight decline from Q4 2021 through Q4 of 2023. So it's like when you look at different metrics, and again, not when you look at increased control, hesitancy on the international side, slowing foreign direct investment. Okay, so how did we achieve a beat again? So then when you start looking at the lower rated corporate bond spreads remain elevated, you're seeing that there's still concern in the fixed income market. It's gotten better, but in 2023, from January to this period, they've improved, but not to a huge degree. So there's the fixed income market is still telling you there are some concerns in the market. And then youth unemployment is approaching the pandemic highs. So you're telling me that unemployment declined, that the economy beat estimates, but you have youth unemployment of the 16 to 24-year-olds, which is approaching the highs that we saw during the pandemic. Again, not a good situation. So now when you look at export growth is not matching China's large industrial enterprises. So going deeper again into the Q1 numbers, there's a wide discrepancy between reported headline nominal export growth versus growth in exports from large-scale industrial enterprises since late 2022. So did smaller firms really make up that difference? Because based on export values by large entities, it's steeply negative versus the headline export numbers. So that's why when we talk about imports, imports are still negative and showing that slowdown, while again, exports for the largest entities are actually firmly negative in general. So imports are negative, which is an indicator. So as we were saying, imports have been under pressure, therefore exports should come down, but exports had a nice bounce. And again, this is just more discrepancy in the data. So then when you look at Asian goods trade has come under severe pressure. So there's a big upside surprise within the Q1 GDP, but lots of attention to exports, production, retail, but average imports were only at 0.2% year on year. China's reopening again looks self-contained, but it isn't providing a boost for its goods into trading partners. And that's where again this conundrum opens up, because you're like, all right, well, you kind of scratch your head, and not to say that there's to say that you have to question Chinese numbers is not surprising. The question is just the disconnect is just growing and gives you some idea of why we have such hesitancy here. Now, falling steel margins, production profits in Chinese mills vanished on a supply glut. So you have a ton of supply of steel and other products. Shouldn't you be having a significant amount of demand given where you are, but you saw a slowdown in construction? So again, just more kind of questions into the cycle. But now when you look at China's disposable income and consumption, Chinese household savings, so the strong recovery in Chinese consumption in Q1, over 30% quarter on quarter, is partly due to an increase in household disposable income and a reduction in the savings rate of some 3.5% of income. So retail sales, again, up 5.7%. Online retail sales grew 7.3%. Final consumption contributed 66.6% to growth in Q1, which is a big increase over the anemic 32.8% for all of 22. So Meng, like many other officials, these numbers from Q1 have laid a strong foundation for consumption recovery throughout the year, but we still need to do more to sustain a consumption-based rebound. To that end, Meng revealed that Beijing is drafting plans to stimulate big-ticket items, services, and shocker, rural areas. She also said more efforts will be made to stabilize auto consumption, particularly new energy vehicles, increasing income, stabilizing employment, ensuring consumers have the ability and confidence to consume. But no one said how. So as the memory of zero COVID fades, and again, things pick up, consumers will feel better, but throughout the longer term, Beijing still hasn't provided the pathway for it, especially given the pressure people feel in general. So then you look at Chinese excess savings rates is still above trend, implying that households have still not drawn down their excess savings during the pandemic and have continued to increase their bank deposits. But again, they're still deeply underwater from the loss in real estate, but real estate construction continues to fall, which means that their investments continue to be underwater. And even if with a bounce in pricing, they're still near 20% underwater between what they lost from real estate and what they have today. Again, more pressure there. Now shifting to India for a minute, CPI fell back within the central bank's range. It was expected at 5.7, came in at 5.66. Industrial production expected at 5%, came in at 5.6. Exports came in at negative 13.9. Imports came in at negative 7.9. Wholesale prices expected at 1.6, came in at 1.34. So all in all, inflation is kind of stabilizing, but imports are slowing. And again, I can't stress enough, imports are slowing, exports are slowing. That's going to continue, and they're going to see that pressure as we've seen around the world. Japanese median inflation on a year-over-year basis, it is the highest it has ever been. Machine tool orders expected prior was at negative 10.7, came at negative 15.2, while PPI expected at 7.1, came at 7.2. Exports slightly better, but imports worse. So exports were expected at 2.4%, came in at 4.3. Imports were expected at 11.6, came in at 7.3. So again, inflation is rampant, and that is a huge problem, which is why the BOJ is going to raise rates. Japanese negotiated wage increases were up, great, came in at 3.76%, but labor cash earnings, Labor cash earnings were less than 1%, and real cash earnings, even with the wage increases, was negative 4%. That is a huge overhang for the Japanese economy, Japanese spending. They're still maintaining some of those exports, but as imports slow, industrial activity slows, you are not going to get spending from the local population because they're getting squeezed more and more. The BOJ is going to have to raise rates, and that's going to be a bigger problem. Next week, we'll talk more about South Korea because we do have some more data on South Korea and Taiwan, and we'll cover what happened with some of the flyovers and pressure that China was doing with Taiwan next week as well. If you have any questions, please let us know, and we hope this helped, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.